Thank you for joining today's webinar, Price Risk Management. My name is Jodie O'Brien and I'm part of the SheepConnect SA team. SheepConnect is supported through funding from Australian Wool Innovation, the South Australian Sheep Industry Fund and the Department of Primary Industries and Regions. For more information about SheepConnect, you can go to our website, sheepconnectsa.com.au, and I welcome you to follow us on Twitter at SheepConnectSA. Tonight's webinar is being recorded and we'll upload it to the SheepConnect SA YouTube channel in the coming days. We then welcome you to revisit the webinar or feel free to share it with your friends. Tonight's presenter is Andrew Dennis, also known as AD to most of us in the industry. Andrew is from Rosewood Wool Services and has been involved in the wool industry for the past 30 odd years, from wool growing, classing, processing, international trading and advising. And AD is currently an independent advisor, a top yarn trader working both in Australia and around the world's wool markets, with 15 years spent buying and selling wool futures to hedge international sales, as well as helping growers manage their price risk. AD still enjoys working with wool growers to look outside the farm gate to learn more about their customers and what drives the actual wool prices. At this time, I'll hand over to AD. Thanks, Andrew.
Thanks, Jodie. Yes, so welcome everybody. And wool futures is certainly, or price risk management, to be more correct about the term, is certainly a hobby of mine and something I love to talk about. But please, be advised, I'm not a licensed futures broker, if that term exists these days. So it is general advice. I must thank Elders and Southern Aurora Markets and AWI for providing some of the material in the slides tonight. So yes, I want to talk about price risk management. Why should you as growers worry about price risk? What is available and when to do it. So I'll just flick through some slides and talk as we go. As Jodie mentioned, there'll be a Q&A session at the end of it, so we just roll along. This quote, when it came out in 2002 from Donald Rumsfeld, I thought it was just mumbo jumbo, but the more you actually look at it, the more it actually makes sense in a strange sort of way. Talking about what we do know and what we don't know, and he twisted it around to talk about known unknowns and known knowns. But the summary, I suppose, is that we do need to expand our known knowns, reduce our known unknowns, and find the best way to manage those known unknowns rather. So it actually is a good way to introduce, what we're on about with price risk management, is trying to reduce those factors which might surprise us down the track. Southern Aurora Markets did a survey of wool producers, and some of the findings, well, they don't surprise me, but putting them on a slide sort of highlights the facts, unfortunately, that the knowledge of price risk management among wool growers, is half of average or good, but the rest are, don't have a lot of knowledge about price risk management. The same with the effect on profitability, that, everyone acknowledges it, but they haven't been able to get the information or the knowledge to work out how to manage it and reduce that risk. A lot of people just say there is not enough information there. Having spent 20 years in the industry from trading and broking, the information is there amongst the sea of other information, admittedly, and it's just a matter of getting it to the people, as in wool growers, at the right time when they've got a window of opportunity to actually sit down and listen to it. Interestingly, and something that I've known as a fact for a long time, most wool growers get their information from their wool broker, and so that's why, as a wool broker, when I was wearing that hat, it was something we certainly pushed amongst our clients to try and increase the awareness and increase the uptake of price risk management, and it's something that every broker in Australia is still trying to do now. Selling of our wool, again, it's not rocket science, but it is just highlighting the fact that 80% of people just prefer to sell their wool through auction. That doesn't preclude price risk management. It actually enhances the need for price risk management. A lot of the brokers are well versed in price risk management and have tools and have tools on offer, but it's just a matter of, again, probably getting the right timing so that the wool grower is receptive to that discussion at the right time. Something which complicates the issue sometimes is just the way that people talk about wool. Growers often talk about greasy cents a kilo or dollars per bale. The wool trade from the auction floor onwards, right through the pipeline, talk about clean cents a kilo. That's the only thing that matters to them. And if everyone was actually on the same page talking about the same unit, as in clean cents a kilo, a lot of the language and a lot of the pricing would be arguably more transparent and easier to understand. The other big drawback for wool growers embarking on a price risk management strategy is cost of production. If you don't know what it costs to produce your wool, you don't know what is a good price to sell it at. So, there's 40% of wool growers who do know their cost of production very well, and they find it much easier to make a decision about a price risk management price than somebody who's just cruising along and producing 100 bales a year and looking at the wool check at the end of the year and saying, yeah, that's good or that's bad. So a big part of the whole equation is knowing the cost of your production, and I think it is increasing as time goes on, but it's certainly something that wool growers need to be aware of. So why is price risk management important? And again, I've pinched some of these slides from Southern Aurora, and a lot of government departments, a lot of strategy is pointing towards price risk management. We know that everything is getting more volatile. Agriculture is certainly no exception. It's not just the climate volatility, but it's the financial volatility, the market volatility, as we've seen with China and a few commodities in recent years. There is a lot of volatility going forward, and there are lots of organisations are, I guess, pleading with farmers to actually take out as much risk as they can from their enterprise. If we look at the production volatility in sheep, it's actually quite low. The price volatility, again, is something to consider, but for wool, the production volatility is very low compared to most other commodities, but the price volatility is among the highest in the agricultural sector. So it just points towards the need to cover that risk where it's possible. If we look at the climate risk involved in sheep farms, it's actually quite low, but the price risk, again, as this slide highlights, is actually very high. So if we can mitigate some of that price risk, wool growers are going to sleep better and arguably manage their enterprise better. As Jody said, I've been involved in the wool trade for a long time, and I've been passionate about futures ever since the mid-90s, really, when I had the opportunity to trade futures on the Sydney Futures Exchange. It's still a physical exchange at that time. I would have to ring the broker. They would have to go and put one foot inside the ring on the floor and then trade with the other party. So they actually had to physically go to the trading floor. They couldn't do it on the screen. Screens came in a few years later, but at that time when I started, the broker had to actually physically put his foot inside the ring to make it a legal trade. And the Sydney Futures Exchange was actually started with wool. That was the first product to be traded. And it was, doing a roaring trade. As you see, in 1970, they traded their 1 millionth lot. As far as a hedging tool or a price risk management tool for wool growers, the Sydney Futures Exchange was not that flash. It was pretty difficult with the delivery specs. It was a deliverable contract, so you had to come up with the 2,500 kilos of wool, and it had to be within the specs, and there were premiums and discounts which didn't always go the way that you wanted them to, and it was a complex process, or you had to trade out in a hurry as you got close to settlement. So it wasn't grower friendly. Macquarie Bank stepped in 95 to try and make something better, make something more user friendly. They lasted for about 10 years before getting out, and eventually the whole wool trading system has been replaced by the Ryman system, and they are still trading over-the-counter forward products, which I believe are very grower-friendly. They're a fantastic product these days that growers can use without the fear of getting caught in a squeeze and having to deliver wool that they don't have in the shed and all this sort of stuff. So it's actually a really good system. There's a lot of myths and challenges, as the screen says, about the futures industry and what's going on. Is it gambling? Yes, farming is gambling, unfortunately. You are gambling about the weather and the price and the sheep health and all the rest of it. But removing some of the risk makes that gambling less volatile, less risky, and less dangerous. So yes, it is gambling, but it's trying to manage the risk to reduce the downside. A lot of people say that if I hedge my wool and then the market goes one way or the other, I've lost. Losing, depending on the strategy you put in place at the time, losing on a hedge is sometimes a good thing. People are saying that the forward market is always in backwardation. I'll show a slide in a minute that proves that it's not, but the cost of interest and storage is built into any futures market, and that adds cost each month. So without any other market forces, yes, the forward price, the further you go, is generally lower than the spot price, but it doesn't mean it's always in backwardation. And people are sometimes wary about the other party in a forward contract and saying that they know what's going on. They only want to buy when the market's going to go up. For instance, if you're a grower thinking that the other party is an exporter or a trader and they just want to buy cheap, everyone's got their own position, their own book. They might want to buy at the same time that you want to sell, or it might be the contrary position. But everyone is just trading their own book. They're not trying to rip you off. They don't know who you are on the other side of the contract as the contracts are traded at the moment. It's all anonymous through the broker. And so there's no contact between the end purchaser and you as the seller. There's no competition, if you like. Everyone is just trading their own position, what is best for their business. Some large operations think, no, we don't need to trade futures. We sell some wool every month of the year. Yes, that's a arguable position, but I would contest, why do you sell wool at a low point of the season when you could have hedged that particular clip or that particular month and actually increase the returns? You don't have to hedge everything every month. But if you can hedge when the clip is when the wool market is traditionally low in August, September, for instance, that's going to protect the price in those months at least. And other people are saying that I can store my wool and wait till the price increases. Yes, you can at a cost, which is sometimes not realised in a farm situation where they store the wool, but they're actually paying storage and interest on that product. And yes, wool luckily can be stored for several years without it going off, as we saw back in the stockpile days where we used wool that was 10 or up to 15 years old with little or no processing discount. But surely having the money back in your bank and being able to use it again is better than just sitting on the wool and hoping for a market increase. And similarly, selling 2 clips in 1 year when the wool is high or holding wool, waiting for that market to turn and go up again, is good if you've got the financial position to do it, but not everyone's in that position, and it just puts so much more risk on the table to run that sort of strategy. So I spoke about the forward curve being in backwardation, meaning that the price, the further out you go, the lower the price based on the cost of interest and storage of the underlying commodity. So that's often a normal curve for the futures market, looking further out. But conversely, it can be pushed around just depending on what the forward market is thinking, and it can It can actually be very flat, or it can be going up, depending on what the further outlook is for the underlying commodity. So I suppose for growers who want to hedge, we need to understand what we're trying to do and take a clear path as to how we're going to manage their risk strategy. And there's different ways of doing it. I included this slide because I just like the saying at the bottom that the best time to plant a tree was 20 years ago. The second best time is today. So I suppose it's about starting hedging, starting to manage the risk. You don't have to forward sell the whole clip today or tomorrow. It's just taking a piece of the forward contract and just watching it. And even as I've said to many growers over the years, okay, if you don't want to do it, but let's just assume we did it today and we'll do a make-believe contract. So we'll write out a contract as if we were going to sell 20 bales or 50 bales, and then we'll watch it through to maturity so that we can see what would have happened. So at least we're starting the process of thinking about the strategy and seeing how it works. But to do it, we've got to start somewhere. And so once we understand, the cost of production, then we know, yes, I want the cost of production plus 15, 20, 25% margin. And then I can set my price and I can start selling when the price meets that target. So as I said before, wool is a very volatile product. This chart shows the number of instances when wool has jumped by more than 30 cents. Today, classic example, the price of wool's gone up by 50 cents, depending on the micron, or more, up to $1. So wool is a very volatile product. Yes, it'll move up, it'll also move down, often by the same margin. So this chart just highlights the volatility is getting larger as we go forward, which just, to me, screams price risk management. Everybody's seen the price of wool jump around, and this is just a very quick snapshot. 19 micron, which is almost the average merino micron these days. I think we're sitting at 19.3, but it just highlights the volatility between 700 cents and 2,400 cents over a 20-year period. And if you can just cut off the bottom, say 20% of those prices by hedging forward, the overall gross margin for your business has to be so much better. It's not a point of saying, let's just get an average price every year, but let's just trim off the worst prices when the forward market allows us to do that. And again, just a different way of looking at the volatility, saying that, yep, when the market is good, it really jumps, but when it's bad, it spends a lot of time below the line. And so we can just see over a 40-year period in this point, the average is 11.96, but it can be double that, or it can be 60% of that price. So again, if we can reduce some of the downside so that we're not selling at the bottom, or that we've got risk measurements in place to capture more of the upside than the downside, the financial position is going to be so much better. Why is wool volatile? This chart is just endeavouring to show some of the things that trigger the price volatility in wool, and it's not always what we think. Hindsight's a wonderful thing. We can often pin a reason on the spike or the crash later, but a lot of it we don't see coming. Certainly, we've had some shocks over the years, like when the stockpile was finally sold in 2002, the market went crazy for a fairly short period of time and then came back down again. Things like the global financial crisis obviously have a marked impact, but then the recovery can be equally violent in the other direction. You'll see that on the right-hand side, the COVID pandemic, relatively short-lived in terms of wool prices, but it was fairly dramatic too. The downturn for 6 months or so. Hopefully we're well past that now, and maybe we'll see something like today's spike if it continues, and we'll put a label in as the Chinese COVID recovery. So Time will tell. As I said, these sort of charts are easy to create with hindsight, but they are global economic events that often trigger a large market movement, some of which can be hedged against by using the futures contracts which are out there at the moment. So a wool grower that knows his cost of production and wants to hedge some of his clip still needs to decide what sort of strategy is going to be best for their business. Are they wanting to be a price fixer where they fix in a certain percentage of production to say, yes, that percentage, I'm happy to sell that 20-30% of my wool clip, that will cover my cost of shearing and other costs, and I can sell it. Then I can sit and look at the rest of it, do whatever my strategy suggests, but I cover a portion at a fixed price, at a certain percentage above my cost of production. Other people might be the opportunistic hedger. They may just choose to say, yep, that's a great price, I'm going to take some of that. And they might just keep loading up as the price gets better and better. And they might end up hedging up to 80% of their clip. Generally, as a rule of thumb, I talk to someone about hedging 30% because generally that's going to cover the cost of shearing and allow you enough cash flow to wait a month or two if need be to watch the market for the rest of it, but you've got that immediate cash flow. An opportunistic hedger might say, yes, at a certain decile of the market, I will just keep taking more and more hedging of my current clip, and then I'll start looking at the future clip as well. Today, I noticed they're getting bids out until 2026. So if anyone's interested in hedging further out, the market is providing the other side at the moment. The active hedger is sort of the professional hedger who wants to play the game, or just says, yes, I'll do it at this point, and no, I'm not interested if the market is down at a certain level, and they've probably got the financial capacity to ride out a season or two when one of those global events happens and we dip below the line for too long. They'll just sit and wait. Trying to put a pin in the sand and say where do we hedge at which decile or percentile really depends on your longer term view. So these tables are all for 19 and 21 micron, but they're for different time periods. So starting on the left, we've got 2-year time period, over on the right hand side to a 40-year time period. So if we look at a 80% percentile, the 19 micron price in the last 2 years has been 1701. But if we stretch that out to a 5-year time period, the 80th percentile is 2169. Most people will look at a 5-year or maybe a 10-year decile. Going to 40 years takes in a lot of time, a lot of data, and a lot of different industry facets. If you like, you're starting to almost drag in the Korean War, not quite, but certainly the 70s and 80s, and then the stockpile issues. So coming back to a 5 or 10-year time period, if we look at saying, okay, at 80%, I want to hedge a certain amount of my clip. So if we look at a 5-year percentile, 80%, a five-year decile chart, sorry, at 80%, 2169 for 19 microns. If I can get that, I'll start hedging. Or some people might say, yeah, at 70%, I'll start putting a toe in the water and doing something. So finding where to put that peg in the sand, I would suggest we'd look at 5 or maybe 10-year data and put a peg in the sand at somewhere that you're comfortable with, to say at 70%, 70th percentile or the 80th percentile of the market over the last 5 or 10 years. Yes, that's a good place for me to start selling. Obviously, if the current market is down in the 40th percentile for the last 5 or 10 years, so 19 micron at 1710, well, why would you be selling unless you're seeing global recession on the horizon? There's probably a better chance that the prices will get better than where they've been 40% of the time in the last 5 or 10 years. So it's a useful tool, but you've got to fine tune it down to say, okay, let's just look at a 5-year period, because that gives enough for more than one complete cycle of the wool market, which is generally 3 years. And we should have the ups and downs to get an average price that we can talk about with confidence. So my advice is usually a 5 or perhaps a 10-year comparison table to put a peg in the sand and say, yes, at 70%, I'm happy to start selling. At 80%, I want to sell a bit more. At 90%, I'm selling a lot more. And another way of looking at it is over time. So the closer you get to actually selling, so the months to maturity, the more you are selling. So in the left-hand side, we're 1 month out from shearing and selling. Some people will say, if the price is at 80%, we need 65% sold. If we're still 2 years away and the price is at 80%, yeah, I'll sell 10% because it's a good, safe level, and I need to feel that I should have some of that, so I can just keep chipping away. So it's a matter of setting a risk profile to say, at a certain price level, yes, I'm a seller, and I want to sell this sort of percentage of my clip, rather than just diving in and say, yeah, I produce 300 bales, I want to sell it now. Let's have some strategy involved and say, at a certain percentile of where the market has been for the last 5 or 10 years, I'm a seller of a certain portion of my clip, so that at least by putting this, I keep saying, peg in the sand, you've got some idea of where you're traveling and what's a good strategy to have, and then obviously sticking to that strategy is important. Whenever people are talking about the futures contracts and selling their wool, the word basis comes up, which is simply just the difference between 2 microns. Hedging a 17 micron clip with a 21 micron wool contract is probably not a good thing unless you really want to play the basis and you've got a strong view on where the basis is going. For a fair period between 2011 and 2016, the basis was nothing. All the microns just moved up and down in sync, as you can see in the middle section of this chart. The last 2 years been a very different story, and the super fine wools have gone on a heck of a run, as everybody in that part of the market is well aware. So hedging the micron contract on the futures market, which is closest to your produced micron, is a safe option. Starting to hedge a 21 micron wool clip with a finer micron futures contracts can get you in a mess unless you fully understand the basis and want to have a view on that and say that 19 microns are going to keep going up, therefore I'll win, or vice versa. So easy rule of thumb is hedge what you produce as close as possible. And again, just a different way of looking at this basis chart. We used to say 500 cents is a good basis between 17 and 19. We're currently sitting at 700, probably closer to 800 now. Difference between a 17 and 19 micron. So it's just something to be aware of, but your wool broker should be very easily able to advise you and direct you in the right way to hedge without incurring any extra basis risk. So what sort of contracts are out there? If we look at someone who's producing a 19 micron contract, okay, they're going to hedge with a 19 micron indicator. The indicator contracts, I think most brokers in the trade will actually do this. It's a cash settled contract. The settlements are added or subtracted to your wool proceeds. Why is that? Because if they just give you a check for the futures contract or a debit on your account, that becomes a financial product. If it's attached to your wool contracts, your wool sale proceeds, it's part of your wool sale, and therefore much easier in terms of regulations and APRA and all the other stuff. So it's always attached to your wool sale proceeds, and it settles on the day that you sell your wool. So there's no physical delivery these days. with this sort of indicator contract. So nobody runs the risk of having a crook season and getting tender wool, or having a really good season getting too much VM, or producing slightly coarser than they expected and getting penalised for micron. All that sort of stuff has been taken out of the equation because these indicators are cash settled, and then the cash settlement is applied to your wool proceeds. So it simplifies the whole process for everybody in the pipeline, and it works just as well for exporters and processors as it does for growers. An exporter wants nothing less than to receive a parcel of wool, or be offered a parcel of wool at the settlement time, maybe 110 bales to fill a container, and the micron's wrong, or the VM's too high, or it's too tender. That's a nightmare for them. They would much rather just have cash so that they can go into the auction room and buy what they really need to buy. By the same token, your wool, when you settle the contract, when you sell your greasy wool, you get paid for what the wool is worth compared, according to the market on the day. So there's no penalty applied in the futures contract. It is just settled purely on the MPG, and so there's no penalty imposed because your wool's a bit burry or whatever. The market just takes care of your physical wool, and then you get the premium or discount added. So in the first example here, contracted price was $21.30. When the grower sold his wool, the market had fallen just over 100 cents. So the price was $20.27, 103 cents times by 5,000 kilos. There's a contract adjustment of 5,150 added to your wool proceeds. Second scenario, 19 micron again, sold at 20.65, but the market's gone up. And so there's 223 cents by 2,000 kilos in this case, which is debited to your wool proceeds. Did I lose as a grower? No, because I covered my risk at the time, and then the rest of my wool clip, which was not hedged, I sold it at the equivalent of 22.88. I hedged what I needed to hedge to manage that risk against the downside. So that's the simplest, most common forward contract out there these days. I think every broker in Australia will offer that, and the grower is not actually dealing with the exporter. They're dealing through Southern Aurora Wool and Ryman, so that the counterparty risk is sorted out. Exporters don't want to be dealing with 150 different wool growers and worried that someone's going to be slow in paying or whatever. So it all goes through a central exchange still, if you like, a clearinghouse, and the vendor risk on both sides is taken into account. And it is all working very, very well. There's actually much more depth in the exchange now than there used to be. Often when it's a flat market, it's difficult to get someone to sell. When the market's roaring, it's difficult to get someone to buy. So it's actually a system that's working very well. But if we look at the second example here and say, well, I was hedging, but I'm cranky that the market's gone up and I've lost money. There is a way around that now, which is, I think, the best product that's out there at the moment. And again, I think most brokers can offer this product, and it's called a guaranteed minimum price. So it's using an option as an insurance premium. The big thing to realize with this sort of contract is that time costs money. So if you want to do a guaranteed minimum price contract for 2024, 2 years away, it's going to cost a bomb, because it's so much time that whoever's providing the option has got to factor that into the cost. And so it's a much better tool for hedging in the 3 to 6 month period. So you think, yes, at the moment, the market, it could really roar. I'm cheering in September, and 21s at the moment are trading at 14.50, 14.70. I can sell them on the futures at the moment for 14.30. But if it goes to $15 or $16, I want a piece of it. Okay, this contract allows you to do that, because you actually buy that option from the option seller who are just professional option sellers that will calculate the price. If the market goes up, you get the upside. As a wool grower, you get the upside minus the premium that you've paid. So on the right-hand side, scenario 2, the grower pays the premium, so he gets the net price, but he actually participates in the upside. If the market were to crash because China gets another COVID wave, on the left-hand side, the spot price actually goes down. The grower's minimum price is the spot price on the day when he took the contract minus the premium. So you can't get less than 13.40, 13.75 or thereabouts. But if the market does roar, okay, the sky's the limit minus that insurance premium. So as I said, time is a cost. So if you want to go more than 6 months, this sort of contract can be expensive. But in the 3 to 6 month window, it's a fantastic product that, yes, you pay 20, 30, 40 cents maybe, depending on the volatility and where the market's at, as an insurance premium, which if we just think of it that way, we burn our insurance premium, we just give that away. It's a cost, maybe tax deductible, not sure. We just use that insurance premium to cover our downside, but it does let us participate in the upside. So this product is relatively new in terms of the wool industry. It's been around for 15 odd years, but it is, and the more people that use it, the more option sellers there are, and the better, the lower the insurance premium, if you like, becomes. And it's just, to me, is the be all and end all for a wool grower that he, for a cost of say 30 cents, he can cover the downside but still participate in the upside. So I think this is the pinnacle of hedging in the short term. It's not such a useful tool for a 12, 18 months scenario, but certainly in the shorter term, it's a fantastic way to go. People are asking, where do I get more information on these products? There's a lot of different sources. As I said, most wool growers get information from their wool broker, but there's certainly plenty out there. The Woolmark Learning Centre on the AWI website, under their program library, have just put in a wool price risk management module, which you can go through at your own pace and just learn about the system and run through scenarios and just learn a lot more at your own pace about risk management. So well worth having a look at that on the AWI website under their learning centre, because essentially wool growers are paid for this learning centre. It's a tool to use by wool growers. So I recommend that everybody has a look at that module, whether you just flick through it or whether you go through it from start to finish is up to you, but it is a very good resource. The Ryman screen, you can actually log on to Ryman and see what the market is doing. You can't trade as a wool grower unless you apply, but generally your broker will trade, but you can see what the wool market is doing live every day for the different microns, and they also have a spread contract. So at the moment, 19 micron today was, there was plenty of bids there, not too many people willing to sell at the moment, except for September. So that's the actual market trading. So you can see what's happening, and it's a public forum. On the WoolQ home screen, the main indicators there, and you can certainly filter the information, have a look and see what the forward market is doing, to just give you a quick snapshot of what the forward market is actually doing at the moment as soon as you open the WoolQ homepage. AWEX obviously provide a lot of market information, and on their weekly market report, they provide a 5-year percentile chart, which I was telling you about, and just gives you a brief snapshot of where each micron is at the moment. So you're not going to hedge 28 micron at the moment. It's the third percentile for the last 5 years. So 97% of the time, 28 micron's been higher than it is today. But 21 micron at 56, okay, I'm starting to think about hedging because it's a pretty good price over the last 5 years. So AWEX is a source of information. Obviously, companies like Elders and other brokers will provide a more detailed chart, so you can look at 21 micron, yes, 55% at the moment over the last 5 years. So it's worth considering hedging, or looking at where I had my hedging strategy in place. And yes, I'm going to start to hedge at 10% of my clip at 60%. So I'm going to get ready and maybe put in a GTC order. Again, elders will actually format the offer board from Ryman, so you can see where the indicative price level is. That for this as of December. Sorry, it's a bit old. You could sell 21 micron in February for 1,400 as a forward contract, and further out the curve all the way out to August 24 at 1,390. So just giving you that information. Most brokers will have the same sort of info at their fingertips, which if you ask them for it, I'm sure they'll provide it willingly. So I've rambled on quite a lot. Probably got the feeling that futures is a bit of a hobby of mine. I think it's a fantastic tool for growers to manage the risk, because that's what it's all about. Helps you sleep at night, and can actually improve the overall financial position of your enterprise. So it's not difficult. Every broker is well versed in the mechanics of how it all works, and quite able to offer products for you. But at the very least, I would urge growers to say, okay, I'm not comfortable to do it yet today, but I'm going to start with a dummy contract and just write it up and say, okay, on the 7th of February, I hedged 10% of my clip, and today's price is this. Okay, let's see what happens when I shear in September, and what would have been the outcome. At least follow it through, and so you get an understanding of how the system works. Or if you are comfortable, create a strategy and put it into work. Because, as I said, with the minimum price contract, there is very little downside. That insurance premium that you pay, that's the only downside. So I think there's some great opportunities out there. There's enough other risks which are impossible to control. If we can take some of the price risk out of it, it's much better. I will now hand back to you, Jody. And
hey, thanks, Andrew. Great presentation. I actually got a tongue-in-cheek question that came from one wool grower. Where do you think the market's headed? And you don't have to answer that if you choose not to.
I did tell someone I was going to log in and ask about the market. I think the short term, if you asked me last week, was very positive. And surprise, surprise, it's gone up today. A lot of today's market is currency driven. So I think the short term is good. China is refilling their pipeline. Europe is optimistic. So short term, February, March is looking good. After a 50-cent jump, we're going to possibly see a correction. But in the short term, the next 2 months, it looks pretty good. The medium term is a little less clear, because everyone's very enthusiastic about China's recovery from their COVID wave. But we don't know if there's a second wave coming in when their herd immunity runs out in sort of May. Will that, throw a spanner in the works? Will the Ukraine situation get worse? Will America go into recession? All those sort of things will play out in the 2 to 6 months time window. Post that, I think it's much more optimistic. A lot of retailers, a lot of processors I'm talking to around the world are saying, yep, 23 is going to be challenging, 24, 25, they're going to be great. So people are gearing up for a price recovery, an industry recovery, a global economic recovery. So longer term looks fantastic. So short term, really good. Medium term, a bit iffy. Maybe we should hedge some. Longer term looks fantastic.
Excellent. Great insight there. Thanks, AD. Question that's come in from one of listeners tonight. Is there a minimum clip size to justify hedging?
The minimum parcel you can hedge that you can trade on Ryman is 20 bales, roughly 2,500 kilos. So if you wanted to hedge, if you produce 25 bales and you're happy to hedge the whole thing, okay, you can do it with a 25 bale clip. Most people are going to say, I will hedge up to 50% of my clip. So you're looking at a 50 bale clip as a minimum size. But If you just wanted to lock it in and say, at this price, I'm happy, I produce 25, 30 bales, and I'm going to lock it in. Okay, you can hedge the whole thing. So 25 bales is the minimum contract you can put through the exchange. A broker might do 1 or 2 tons for you, but smaller quantities. But 25 bales is really the minimum size you can hedge. But then you're going to hedge the whole clip, which is not impossible.
Yep, no, fantastic. Thanks for that. That's all the questions I've got at this stage, AD. Thank you everyone who joined us for today's webinar. AD, thank you for sharing your insight and expertise with us. If anyone has any additional questions, you can contact us directly using the contact information in your webinar registration. I thank you for your time and have a wonderful evening.